What's up guys, welcome back to the channel. Today we're diving into something very big, which is on everybody's mind. How much can the stock market go up before it crashes? We've all seen the stock market have done very well for itself the last couple of months, but how much can it go up and rally before it all goes down? In this video today, I will explain to you everything you need to know about the stock market, even for those who've never ever invested in the stock market before, so that you will understand where the market's headed and what to watch out for. So the first thing I want to talk about is that the stock market have made many investors some good money since the last time the Fed raised the interest rate back in June 2023. During this time, the Feds have been taking down the rates and people said, look, hey, there's nothing wrong with the economy. The Feds are taking down the rates and it's all good. The market's gonna go up and keep going up. So here's what happens when we get lower interest rate. Borrowing becomes much more cheaper, so businesses and people start spending more money. It creates the illusion that things are getting much better, but in reality, it's just for the short term. Just because we're getting lower interest rate doesn't mean that the economy is doing better than ever. So here's the thing. One of the things that smart investors absolutely hate is uncertainty and anything that can bring more uncertainty into the market. So just before the election, people are more cautious when it comes to investing. No one wants to take big risks because they don't know what the coming next week and months will look like. And when investors are cautious, the market gets stuck, it gets stagnant. So how does the election really affect the market? Well, if things get politically unstable or there's an unexpected result in the market, it can react very negatively and it can react very fast. That's why the market often holds back a little bit just before the election. So here's a fun fact. When the markets are up more than 10% of the first half of the year, the market tends to have a big rally in November and December. Now, a rally is when the stock prices jump up really fast because the investors start feeling very good about the market. And this can drive prices higher and higher as everyone piles in and want to be involved in the stock market. So let's go back and have a look how the stock market did prior to the last election. So September 2022 turned out to be a challenging month for the markets. The S&P 500 and NASDAQ both saw a decline, with the S&P falling down about 9% for the month. This was driven by renewed fears of aggressive rate hikes by the Feds when they were slowing down the economic growth and persistent inflation. September is historically a tough month for the stock market, and 2022 was no exception. And October wasn't much better. October started with further volatility but ended on a more positive note as the market rebounded in the second half of the month, with the S&P posting a strong recovery of about 8% in October. And this recovery was fueled by better than expected corporation earnings and speculation that the Fed might slow down the interest rate hikes. In other words, not having the Federal Reserve keep bringing up the interest rate to much higher levels. November 9th, post the election. Now, the stock market saw a very mixed reaction immediately after the midterm elections. Historically, market tends to react positively to the results of a political uncertainty, but in this case, that wasn't the matter. We had a split Congress with the Republicans taking control of the House and the Democrats maintaining control of the Senate, which led to caution of trading. In other words, people were more cautious or more careful investing in the stock market because of the split of the Congress. And then we had the late November rally. So later in November, the market gains a little bit more of a momentum, with the S&P 500 raising by around 5.4% for the month. The rally was fueled by optimism that the Federal Reserve might slow down its rate hike, as inflation data showed that there's a sign of moderating. And then came December. The market started December with a continued rally from November, driven by a positive outlook on the inflation and the Fed's potential response. But it did not continue in that direction. Mid to late December, however, the market experienced a renewed volatility as concerns about the impending recession and the Federal Reserve ongoing aggressive rate hikes were weighing into investor sentiment. So, what did the Fed do? The Fed raised interest rate by 50 basis points only in December, and the Fed's chairman, Jerome Powell, indicated that there will be further rate hikes coming very soon. So what happened to the market? The S&P 500 ended up going down by 5.9%, capping on a tough year for the stock market. January 2023 started off strong. The stock market started the year on a very strong note, with the S&P gaining around 6.2% only in January. And the rally was driven by a combination of various factors, including a slowdown in inflation, optimism about the soft landing for the economy, and a strong corporate earnings reports. So what about the tech companies during this time? The technology sector, which had been hit hard in 2022, led the rebound in January, with companies like Apple, Microsoft, and Tesla seeing significant gains. February 2023. The rally from January continued into early February, supported by a strong corporate earnings and continuing optimism about the inflation moderating. Mid to late February, as the month progressed, concerns about the inflation persisted, particularly with the release of a stronger than expected economic data. This led to renewed fears that the Federal Reserve might need to keep the interest rate higher for a longer period than initially anticipated. So at the end of February, the S&P 500 ended up slight decline of about 2.6% for that month. And this gave the investors a mixed feeling in relation to the economy and the stock market. Well, look, I've sold 65% of my portfolio, ready to buy some bargains as soon as I see something to grab on. So I'm happy to be cash liquid for the next 2 to 24 months without a problem. Hopefully it doesn't take 24 months or more, but yeah, I'm patient. But at the same time, I'm not a really massive fan of keeping too much cash liquid, as it loses value against the inflation. But the secret is staying liquid and cash ready during recessions is how you build real wealth, by buying when everybody else is selling and not buying when everybody else are buying. And yes, there is a possibility that we might have a rally anytime soon, but don't be surprised if you see a crazy big one-day sell-off. So I hope the Fed don't delay the stimulus, as in pumping in more dollars into the economy, which will be a big domino effect on the economy and will also increase the risk of a quicker start of the recession. So what actually really happens when the Feds pump in more money into the economy? So one of the first things that happens is that the inflation goes up because more people will start spending more money, and that can quickly lead to a market crash. While on the other hand, I find it rather hard to understand people who are expecting or depending on the Feds or the government to save the situation. Rule number 1, never depend on the government. Control your own money and your own destiny. So here's the biggest debate at the moment: the bulls versus the bears. The bulls are the people who think that the stock market will keep going up, and the bear is the opposite. They are the ones who think that the market is actually heading down. While the bulls are saying there's no way we're gonna see a stock market crash anytime soon, and the bears are saying the stock market crash have already started and we're already in a recession, or that it's gonna come very, very, very soon. It's inevitably that there's a stock market crash happening. So where do I stand at the moment? I'm 100% a bear at this moment. Why? Because it doesn't take a genius to figure out that the US stock market is overly valued. It's common sense, guys. Just do your maths. I'm going to explain how bad off the US economy is at the moment in the most simplest term, so that even a 12-year-old would understand. So let's do some role play. Hi, Mr. Evans. I want to buy your company. How much is it worth? And this is me. My company is worth $55 trillion. And the buyer says, oh, okay, what's your revenue? I go back to the buyer and say, my revenue is coming up to about $30 trillion. This is the buyer's response. Okay, that's a little bit odd that your revenue is nearly half of the value of your company. So what's your company's debt at the moment? Mr. Buyer, my company's debt at the moment is $35 trillion. The buyer says, okay, Mr. Seven, I'm not sure if anyone would buy a company with a valuation of $55 trillion, a revenue of $30 trillion, and a debt of $35 trillion, which means that your debt is higher than your revenue and you're not making any profits and can still not pay off your debt. And the buyer ends the conversation by saying, I don't like these numbers. It doesn't add up. It doesn't make sense. It's a big no for me. Bye-bye and good luck. My question to you is this: if you wouldn't touch my company or any other company with similar numbers with a poll, why the heck are you still buying into the US stock market? Is it FOMO? So here's a fun fact. Just before the dot-com bubble, Microsoft was actually valued at $600 billion, but it only had a revenue of $20 billion. Now going all the way into year 2002, when it hit its bottom, it only had a value of $300 billion. So it was sliced in half within the next 2 years, from its top to bottom, as the stock price of a Microsoft share went from $50 to nearly $20 a share. That was the good old days. So here's my game plan moving forward from now. I'm going to sit on the sideline and watch the market for the next few weeks and even months. I'm not pressing the buy button until I see at least a 25% drop on the stocks that I'm looking for. It's not going to be easy because we're working off late gratification, okay? So what's going to be important now is your patience. So patience is key. Don't let FOMO, the fear of missing out, drive your decisions. Buying when everybody else is selling is how you build long-term wealth. It's okay if your favorite stock keeps increasing this week, next week, or next month, but be patient. Follow the money. Look what the biggest investors are doing at the moment. They are liquidating their funds and keeping a small portion of their funds within the stock market, but they are cash liquid ready, and you should do the same. That's it for today, guys. I really hope that this breakdown have helped you to understand what's going on with the stock market and why I'm being cautious right now. And you should do the same. And it's not only me, it's the biggest investors in the world, and the Federal Reserve are doing the same thing, but they're not marking it out to you so that you can actually see what's going on and explain it to you in terms so that you will understand. They do it on purpose, and that's why I'm here. So if you want to see more of these videos, make sure you like, subscribe, and put your comments down below. Until next time, thanks for watching, and education is priceless.